Going over IRS Form 4972, Tax on Lump Sum Distributions. This form specifically is for lump sum distributions from qualified plans that belong to participants before January 2nd, 1936. However, it also applies to lump sum distributions from qualified plans where a beneficiary receives a qualified plan from a participant born before January 2nd, 1936, and decides to take lump sum distributions. So in this case, it's the qualified plan that is grandfathered before this the date, the original participant, whether or not the beneficiary was belong or whether or not the beneficiary was actually born before January 2nd, it does not matter as long as the original plan participant was. So we're going to walk through some unique aspects to this form. Specifically, there's an option to select 20% capital gain elections. There is a part of this form to choose a 10-year tax option where you calculate the amount of tax that you would pay, and you pay in one lump sum. That represents the 10-year annuitized amount. Or you can do both. So we'll walk through all three sections, starting with part one, completing, you complete part one just to see if you can use this form. So if you go to the form instructions on the IRS website, there's a little bit more information on all of this, but basically what you're going to do is you're going to complete the top of the form just to make sure that you're eligible to use it. And then you're going to complete part two only if you plan to choose the 20% capital gain election. And then you would use part three if you also want to use the 10-year tax option. So in part one, we're going to go through this form just to make sure that we use it. So if we get to a point where we don't use this tax form, but you file IRS 1040, 1040 SR, 1040 NR, the form instructions are very detailed on what you report in your income tax return. Same for if you use Form 1041, for estates and trusts, where you would report the distribution amount should you choose not to use Form 4972, or even if you're not able to. So question one, we went ahead and filled in this form. We'll start at the top with our hero, John Doe. He is the recipient, as we'll say that his father was born before January 2nd, 1936, and he inherited a qualified plan from him last year. So his tax ID number or his social security number in the top right corner. And now we're going to go through a 5-question part one just to see if John is eligible. So question one, was this a distribution of the entire balance from all of an employer's qualified plans of one kind? So a profit sharing plan, a pension plan, stock bonus plan. So to use this form, you have to completely liquidate the entire balance. So we checked yes. And then in question two, did you roll over any part of the distribution? So you can't use the form if you did that. So we did not do that. And then, was this distribution paid to you as a beneficiary of a plan participant born before January 2nd, 1936? And yes, it was. However, John was not the plan participant. He was not the one that was born before, and he was not a plan participant for at least 5 years. So, however, if you check no to both of those, then you don't use this form. He did check box 3, so he can continue to use this form. So in question 5A, did you use Form 4972 after 1986? for a previous distribution from your own plan? No, he did not. And then question 5B, if you're receiving this distribution as a beneficiary of a participant who died, did you use this tax form for a previous distribution received as that participant's beneficiary after 1986? So one of the rules is that you're only allowed to use this form one time for each plan participant. In part 2, we'll calculate the part that to choose the 20% capital gain election. So in this scenario, we're making up numbers here, but we'll just imagine a $50,000 total distribution, of which $10,000 was in box 3 of the Form 1099-R, and then the remainder was in box 2A. So in this case, in line 6, we're gonna put in the $10,000 distribution. We'll multiply that by 20%. So if you don't use part 3, this is gonna be the number that you put in. You'll put it in the total on IRS Form 1040, 1040-SR, 1040-NR on line 16, or if you're filing Form 1041, you'll put it into line 1B of Schedule G. And then you'll also check box 2 on Form 1040, line 16. We're going to go through part 3, and you can check the 10-year option. There's a couple of aspects to this. If this is for multiple recipients, and if there are recipients who elect to include net unrealized appreciation in their taxable income, there are a couple of worksheets in here for you. And then if you also have death benefit exclusions, there's a death benefit worksheet in the form instructions. In our scenario, we're going to go through as if none of those apply to us. As John is a single recipient. He did not have net unrealized appreciation, and there is no death benefit exclusion. So we're going to go through all those parts. Just know that if any of them are applicable to you, the form instructions have specific sections in there. So just pay attention to that. So as I previously mentioned, in line 8, we're going to enter the other $40,000 from John's 1099-R, box 2A. So the entire amount was $50,000. We subtracted the box 3 amount up here, the $10,000. So this is the remainder. It's $40,000. There was no death benefit exclusion, so that's the total amount that we're choosing the 10-year tax option on. In line 11, there is no actuarial amount of annuity. We'll just say that wasn't in there. But if there was one in your situation, it'll be in box 8 on your Form 1099-R. And then you'll add those two amounts to arrive at the adjusted total taxable amount. So if this amount is $70,000 or more, then you'll skip all the way down to line 17. You'll enter that amount in line 17 and then go to line 18. Our amount is $40,000, so we're going to go through lines 13, 14, 15, and 16. So in line 13, we multiplied the line 12 amount by 50%, but we're not supposed to enter more than $10,000. So instead of 20%, or instead of the $20,000 that we would have come up with, it's $10,000. We're going to subtract $20,000 from the line 12 amount, and we'll put that in line 14. So if the line 12 amount happens to be $20,000, you would enter 0. In line 15, 20% of the line 14 amount is $4,000. And we're going to subtract that from the line 13 number of $10,000. This is the minimum distribution allowance, and we'll enter that difference of $6,000 into line 16. On the next line, we'll subtract this $6,000 from the $40,000 in line 12, and we arrive at $34,000. In line 18, in this situation, there is no estate tax attributable to this lump sum distribution. You would see this. I mean, there are special instructions in the form instructions, but you would have to reduce the taxable amount of the distribution by any federal estate tax that you paid on the distribution itself. So we're going to assume that we're well under the estate tax threshold, and this doesn't apply to our situation. So we're carrying down the line 17 number to line 19 because there's nothing to subtract in line 18, so $34,000. So we're going to go through the math here on line 20. We divided line 11, which was 0, by line 12, $40,000. We came up with 0. We multiply line 16 by the 0 to get 0, and then we'll subtract the 0 from the 0 in line 11 to come up with 0. So the tax on the amount on line 23, so the line 19 amount, we multiply that by 10% to get $3,400. And then in line 25, line 24, we basically calculate the tax based on the tax rate schedule. So in the form instructions, following that schedule, we arrive at $396. So we'll multiply this amount by 10. And then since line 11 is 0, we're going to skip lines 26, 27, and 28. And we'll enter this $39.60 on line 29, and which we'll add to the line 7 number with the $2,000 capital gains to arrive at $59.60. So you'll include this amount in line 16 of your 1040. Remember to check box 2, or if you're filing Form 1041, it'll be in Schedule G, line 1B. So that's all we have for this video. Just keep in mind that a lot of your questions may apply. So a couple things that you should note in the form instructions. There's a little bit more information if you're not familiar with a qualified lump sum distribution based on kind of the uniqueness of this plan. There are certain distributions that don't qualify for the capital gain election or the 10-year tax option. So that includes everything that's in here. So, a lot of distributions from an IRA, for example, tax-sheltered annuities, actuarial value of any annuity contract included in the lump sum, retirement plan bonds. So a lot of nuances here, so we won't cover them in this video. Just know that you should take a double check in your form instructions to make sure that all of your distributions are qualified if that's how you want to treat them. And then also has additional information about what to do with multiple recipients. Here's the NUA worksheet. If usually, so securities received as part of a lump sum distribution are generally not taxable until they're sold. However, you may decide to include the NUA in the year that you received it. It's up to you and your accountant. All of these instructions, here's the tax rate schedule that we discussed, and then scenarios on what to do with multiple recipients if you're a trust administrator, for example, or trustee, or administering an estate. All of that's available in the form instructions. So we've written in depth about this topic. You can go to our website. Simply go to teachmepersonalfinance.com, type in IRS Form 4972 in the search bar, and you should see our article. If you like our articles, please subscribe to our newsletter. And if you like our videos, please subscribe to our YouTube channel. As always, if you have any questions or comments, please let us know in the comments section. Thank you very much and have a great day.